Assalamu alaikum and good morning, and welcome to our session as we present the first half performance update for the period ended 30th June 2024. First, I would like to introduce my colleagues. On my right, the Chief Financial Officer, Mr. Craig, and on my left, the Chief Risk Officer, Mr. Majid Al-Busaidi. Okay, so the macroeconomic conditions we see are steadily improving. Although the GDP has modestly grown by 1.3%, we see significant strides and growth in non-oil sectors, representing progress and effectiveness of the government's consistent efforts to diversify the economy and reduce dependence on oil and gas. The average growth of non-oil sectors is about 4%, with some sectors such as services sector actually registering over 10% growth. So the composition of non-oil sector we see as in the GDP, the composition of the GDP and the contribution of the non-oil sectors is nearly 70%, which is what we actually wish to have as part of the overall diversification of the government to reduce dependence on oil and gas. We have seen also a significant rise in foreign direct investments in non-oil sectors, particularly in the first half of this year. Key sectors that actually attract FDIs, including manufacturing, real estate, and industrial activities. And obviously also the establishment of Oman Future Fund by the Oman Investment Authority with a capital of $5 billion is a testament of the government's commitment to attracting investments into the economy and supporting the SMEs as well. This fund is designed to stimulate economic activity and create a more diversified economic base. We also see the balance of trade and the current account balances or positions look healthy. The debt to GDP has consistently actually reduced and currently stands at about 34%. I believe strongly that it's a high time for Oman to get an upgrade on its credit rating, and hopefully we're going to have that by the year end. Although the budgeted deficit is around 600 million, given the trend we see, the effectiveness of the fiscal management actually would deliver the surplus by the year end. So we should end up the year with a surplus. And also given where the oil prices are hovering around and the budgeted oil price of 60, we should be able to post a positive or a surplus position on the budget front. Now, on Sohar International at a glance, we are a bank that is celebrating 17th birthday today, and the first anniversary of the merger by acquisition of HSBC Bank Oman. Our staff strength has grown to about 1,500 members with extensive and expansive branch network of 85 branches, serving over 500,000 customers all across Oman. This year has also witnessed the opening of our first overseas branch in Riyadh, the Kingdom of Saudi Arabia. So the branch network is comprehensively complemented by digital touch points with the state-of-the-art mobile banking, offering services beyond banking. Our market cap has steadily grown since the merger to touch about $2 billion. The ownership is strong, with over 70% owned by the government institutions, and private institutions 16% and others 8%. That has slightly changed post the merger. Right. So since the beginning of our transformational journey back in 2018, we've been focusing on building certain strengths, and we just want to summarize some key strengths that we've been able to actually build over the last 5 years. The first one is the corporate governance and risk management framework. We can discuss that further. The strong ownership structure, the board of directors, and very strong management team. And we've been able to build a strong brand and corporate franchise and invested substantially in our technologies with cutting-edge digital capabilities and robust technological platforms that we've been able to build, and we're going to share a lot more in the next slides. Also, we have managed our capital quite responsibly and optimally, and we're going to discuss that a little bit more. We have very strong liquidity buffers and funding base to support our growth plans on asset side. And also we have been able to deliver solid growth, resilient financial performance over the last 5 years. And you can see on your left side the key indicators on our performance year on year or a summary of the last 5 years. And obviously we have a very robust growth strategy. Now, just to summarize on that, when we began all of this back in 2018, there were some who actually questioned the level of our ambition and whether our aspirations are realistic enough. And there were some who doubted whether we have the tenacity to deliver on our aspirations. And there are some who wondered whether we have the resilience necessary to overcome the challenges. Now, well, the milestones we have crossed, the progress we have made, and the results we have delivered are the answers. And as a testament to what I call Sohar International's IBITA. IBITA stands for imagination, belief, togetherness, and action. So that is the power of imagination, the power of belief, the power of togetherness, and the power of action, which I believe has helped us all through the first phase of our transformational journey, which ended in 2023. And that is the beginning of the next phase of the transformation. So this approach is fueled by an intense desire to drive positive change and make positive contribution, guided by a very clear vision and the steadfast determination and discipline essential for achieving exceptional outcomes that you have seen. So today, we are a better bank. We are a bigger bank. We are a more resilient bank, and obviously the fastest growing bank. But having said that, speed is not necessary here. What matters most is the consistency. So we'll keep pressing on, delivering excellence in value propositions for our customers. We'll keep pressing on to deliver excellence in customer experience. We'll keep pressing on to deliver excellence in digitalization, and we'll keep pressing on to deliver excellence in operational efficiency as we get into the next phase of our transformational journey, which we're going to share briefly in the next slides. And these are the achievements and recognitions that we have enjoyed over the last 5 years, you can see. And this award have given us the motivation and the confidence to aim higher. And our vision has not changed to become a world-leading Omani service company that helps customers, people, communities to prosper and grow. And the values remain unchanged, but the aspirations actually have been elevated. We want to build a world-class enterprise with key strategic objectives of being best in class in service excellence, best in class in growth, profitability, efficiency, and the best-in-class ROE and EPS, the catalyst to Oman's economic growth, the best-in-class value propositions, and the best-in-class workplace. And obviously, we have put in place some key capability map that guide us to focus our investment on the excellence in customer experience. We are investing substantially to deliver excellence in customer experience. We are also investing substantially to deliver excellence in digitalization. The same thing on operational efficiency and value propositions for our customers. So these are the capabilities that we are focusing on. These are the capabilities that we are investing in. And I think if we are able to make significant progress on this, the results will be just byproduct. So we want to become a world-class enterprise and the most recognized financial brand in the region. That, in a nutshell, is the summary of our strategy. And over the first half of this year, we've been able to actually achieve some significant progresses under each of those focus areas: the customer experience, the digitalization, the value propositions, and the operational efficiency. And we've been announcing these over the last 6 months, 7 months. You might have seen that for those who are following our news. And we are very proud with the progress we have made, but more importantly, we are very proud of the capabilities that we have built in as an organization. Right, the brand pillars, we have been consistently communicating these over the last 5 years, remain unchanged. Our vision is very clear, our promise, our purpose, what we stand for, our personality, and our principles. And the investment in our people continues to be one of the priority areas, and obviously we are very much adapting and embracing the global trend. So ESG, we have talked about this in the previous sessions, and ESG is one of the key strategic focus for us, and we have got a framework and the clear guidelines on how we need to participate and contribute in this space. So with this, I would like to get into the financial review, and would let my colleague, our Chief Financial Officer, to take us through all of the key financial aspects of our performance, and then we can get into the Q&A. Thank you very much.
Great, thank you very much, Ahmed. I'd like to give you some context to commence this presentation, and we commence with the 2023 results. As Ahmed mentioned, today is the anniversary of the merger with HSBC, which resulted in around about a 50% increase in the balance sheet, 2.2 billion. The bank's continued to accelerate its growth over and above that initial merger activity, and it's reflected in our metrics. The return on average equity in 2023 finished at 11.1. We're at 14.2, which was a record result for the bank. And that's on the back of a very strong Q1. We reported 25 million. We've reported another 25 million in Q2. So the progress this first half has been consistent, and leveraging the very strong base that we have, we've continued to grow that balance sheet and to manage all our key financial metrics to really place the bank in a position, as Ahmed mentioned, to continue to execute on the strategy which he has discussed. The return on average assets are up to 1.5%, and very proudly, our cost-income ratio has fallen from 47.1 to 40.5. This reflects the tremendous amount of work around synergising post-merger, as well as the continued investment in technology and the staff that we have. The net loan-to-deposit ratio is also very key in terms of supporting the performance of the bank. Net loan-to-deposit ratio, end of last year, was 76.8. We've moved to 71.7%, and that's driven by a very strong growth in our deposit base. This is thematic in terms of supporting our discussions around the strength of the liquidity of the bank. That's been a very strong contributor, and the NIM of the bank, which you can see through public numbers, is at 2.6%, which is very much a market-leading NIM today. So the bank's performance and underlying profitability has been supported very much by that strong deposit base and less reliance on market funding. Some other key result highlights in my context, operating income comparing year-on-year growth is at 71%, net profit 112% increase, operating profit 81%. The balance sheet has also, as I mentioned, increased, total assets 65%, and noting that 50% increase due to the HSB merger. Total equity is very well managed, and that supports the return on equity to shareholders. And we continue to look at the bank's capital position in terms of supporting the growth story. Net loans up 32%. We continue to focus on very high quality credits. And deposits, 107% increase. This is a very key driver, as I mentioned. Looking at some of the other key result highlights, just some trends, just reinforcing my comments around the profit for the period, 23.7 up to 50.3. Return on equity, that movement from 8.4 to 14.2, this is 6 months on 6 months. And also the capital ratios, just to comment on the high levels of capital ratios in June 23, that was positioning the bank for the merger activity with HSBC. On asset quality, as we discussed in some length in the last presentation, the coverage ratio we've increased from 93% to 143%, which is again providing the bank with a lot of strength in terms of its balance sheet. Just reinforcing again the numbers on the profit for the 6-month period. The overall profit before tax is up 116%, and we've improved against all the various metrics. I mentioned the NIM driving the net interest income, 82% up, with an underlying NIM of 2.6%. The operating expenses are growing at a slower rate than the revenue, so it's a positive jaws for the bank. And the loan impairment charges are down for the 6 months, and this is on the back of our strong coverage ratio. On the balance sheet, if we look to the far right, next page, thank you. Looking to the far right on the balance sheet, you'll see the story around the customer deposits, 107% increase. Nearly 2 billion of those deposits are demand deposits, so very much supporting our liquidity. And the equity movements, you can see the bank took the opportunity to repay its perpetual Tier 1 securities, and the underlying increase in the shareholders' equity was 150 million to support the acquisition. Just a summary there on the credit quality to show the movement in the non-performing loans, 5.2 down to 5%. Our coverage, as I mentioned, 93% up to 143, and the cost of risk for the last 6 months is down to 0.5%, down from 0.7. I mentioned the capital and leverage performance, noting that the central bank has reintroduced an increase in the capital conservation buffer of 1.25, but the bank remains well above the regulatory limits. And funding liquidity, our net stable funding ratio, liquidity coverage ratio, supported by strong loan deposit ratio, CASA at 76% is exceptional. And so the bank is very well placed on its liquidity and funding position. I'll leave that for now as a high-level summary of the financials. Ahmed?
Yeah, thank you very much, Craig. And now we'll open for Q&A. Yes, Abbas.
Good morning, gentlemen. Thank you for the presentation and congratulations on a fantastic one-year performance post the merger. I mean, the numbers are for everyone to see. So congratulations on a great set of numbers. Just a couple of questions. When I look at your market share, I think on the asset side is close to 18%. And, you have this liquid sort of balance sheet at your disposal, and extremely competitive cost of funding, sector leading. So in terms of growth, when you look at your balance sheet, and I don't just want to talk about asset, I want to talk about your entire. I don't want to just talk about loans. I'm talking about the entire balance sheet. How do you see that on the asset side for the next 2 to 3 years? What are the key strategies? And from that perspective, can we also talk about the Saudi opportunity? Because you've spoken about in previous calls how excited you are about this Saudi market. So can we just tie in that as well? So that's my first question.
Okay, so the outlook is very positive. We see traction in FDI, we just talked about, on key sectors of the economy the government is focusing on to diversify and reduce dependence from oil and gas. So manufacturing, we've talked about tourism, industrial activities, logistics. All of these sectors actually are very promising. There is a lot of mining, there is a lot of potential for growth, and we are seeing traction in all of these and credit demand. Obviously, as the Saudi market is very promising as well, is the bigger market. We are cautious and prudent in our approach to lending, but there are also very good opportunities for growth. So all in all, I think in these two markets, we see over the next couple of years or 3, very good potential for growth in assets and other areas of our businesses.
Okay. And you wouldn't want to give a number in terms of what you're looking to grow your asset size at. That's not something you want to divulge on the call.
You understand that, Abbas, being a listed company, we can't share specific numbers, but we are very upbeat about the outlook.
Sure. And on the retail side, I've noticed that most of our conversations revolve on the corporate side. Is it because the bank thinks the retail side is not very lucrative with the lending cap at 6%, or is there another strategy when it comes to your retail book?
Now, the retail book has grown post the merger, and obviously with the expansive branch network that we are outreaching now different parts of Oman compared to the pre-merger scenario that we had only about 30 branches or 40 branches. Now we are able to reach out to a lot more market segments that will be very important for our retail growth as well. And the growth in our, or the traction or adoption in digital channels that we see with the world-class state-of-the-art mobile banking, we see a lot of traction there as well, offering services beyond banking. If you do not have an account with us, please open an account with us and register on our mobile banking and see what we have got to offer, and I'm sure people like you will love it, and with that spread of mouth, I'm sure you'll be able to convince others as well to join hands and support us in our growth plan. So we see also potential in retail space as well.
Sure. Thank you for that. And the second question is, I kind of echo your comments. When you were going through the merger, there was a lot of doubt regarding would you be able to, one, hold on to the deposit base, which you've done exceptionally well with, because HSBC obviously enjoyed lower cost of funding even compared to Bank Muscat. So, there was some doubts about that. So, there's a year that has passed and you managed to hold on to those relationships. So fantastic job there. And the second concern was on the corporate side. I'm not sure if HSBC has already launched its corporate business. I know they were going to come back. How do you see that risk when HSBC comes back? Do you feel that the guys who were with HSBC, both on the deposit and on the corporate side, do you see losing them, or is that a relationship that you've sort of managed over the last 1 year and are quite comfortable to retain it?
Abbas, I said it before during my opening remarks and the presentation, just to give you an overview on our strategy right from the beginning, not just before the merger, right from the beginning of our transformation journey. There are some who doubted and asked whether the level of our ambition and aspirations are realistic enough. And there are some who actually questioned whether we have the necessary tenacity to deliver on our aspirations. And the results have got everything to tell us. Actions we have taken, the results we have delivered has spoken louder than words. What we did before the merger or pre-merger during the transition period we listened to our customers, to what their requirements are, and addressed all of those requirements firsthand, in particular corporate customers, because there were some of the corporate customers that had very unique requirements on services. So we had to design or redesign certain service offerings to meet their requirements, and it was beyond their expectations. So that's why we've been able to retain them, and not just to retain them and meet their expectations, but actually exceed their expectations. So we are very glad to what we have done, and for us it's not just the numbers, the results we have achieved, but the process we have gone through have built a lot of capabilities and discipline within the institutions and the team. So that helped us a lot in our next phase of our growth.
Okay, sure, I hear you loud here. You know, I have a few more questions, but let me give my colleagues an opportunity to interact with you, and if there's nothing else, I'll come back.
Thank you. Yes, Nitika.
Yes, hi, good morning.
Good morning.
Thank you for taking my question. First of all, congratulations for completing the 1 year
Thank you.
post the merger. So a great performance. Yes, so starting with my question. So we've noticed the strong performance on the cost to income ratio, the progress has been made. But, and now that you've completed 1 year, what do you think would be a steady state, or going forward, what would be your outlook for the cost to income ratio? How it could it go even lower than these levels?
Look, given we are investing into our growth, and I think it's important to be mindful about, yes, we are maintaining a very prudent level of cost-income ratio. If we maintain at this level, I think it's good enough if we are able to, in the meantime, invest into the capabilities that we need to support our growth plan. So I think we should be better than the market, or among the top in the market, and you should expect us to continue to invest into our capabilities in technologies, in people and processes to support their growth. We are here for the long term, not for the short term.
Right. Okay, got it. And then secondly, on the NPL coverage, so it is at quite reasonably high levels at 143%. So is that what you are looking to maintain, or we could expect provisioning to come down a bit, because 100 to a little in excess of 100 is considered to be a reasonably good number, and you are way above that mark. So what's your view on that?
I think it's important for us to be prudent. We are out of the COVID. There have been a lot of challenges during COVID, and the dynamics of the markets and the geopolitical tensions that we see around, I think it's important for us to be prudent. So I think the 140% is a good level to be at, as long as you can see there is a very steady growth in the operating lines. That's very important. Our operating profit has registered very healthy growth, so the engine is performing. And with that performance, you need sustainability. And that's why we don't want to be very short-term driven and start becoming very aggressive in our coverage ratio, but not being realistic to what we see in the market. So I think it's very important for us to be prudent, and whatever is the right thing to be done, we will do the right thing. So I think that's very important for investors, for shareholders, and for the markets generally.
All right, thanks. So just one last one. I mean, it's on a more broad level. So if we, the understanding is that, the overall credit growth in Oman could be in the range of mid-single digits. So should we expect Sohar to be pretty much in line with this, the overall credit growth that Oman is growing, or, you would expect it to be much ahead, or, if you could give us a sense on that, on the credit growth directionally?
Look, credit growth, our outlook is very positive. I've mentioned the sectors that we see a lot of potential for growth, and all of those sectors actually have high credit demand. The mining, the manufacturing, the logistics, tourism, all of these sectors will demand credit. And I think yes, could be single digit, but could be high single digits, and that is important to note. So we have a very different outlook, and if we have high above 5-7% credit growth, I think that's good enough for the market.
And also our
Yes.
KSA branch operation.
And KSA branch we have, it's very promising as well.
All right, great. Thank you so much.
Thank you. Joyce Matthew, you can ask your
Hi.
question. Yes.
Hi, good morning, gentlemen. Thank you for
morning.
the presentation and congratulations on the good set of
Thank
numbers. See, I have a follow-up question on the credit quality, which you have talked about. When I look at the coverage levels, yes, on overall level, we are seeing pretty good coverage at 145%. But specific when it comes to different buckets, what I'm seeing is on your stage 3 exposure, your coverage levels are still on the lower side. We are talking about only 45% coverage. That's on the stage 3, and on the stage 2 transitions, we are still seeing a lot of stage 1 loans, getting classified into stage 2 bucket. So will it be possible for you to give some color on the nature of these loans, and what are the likelihood that these companies, these companies or the loan portfolio getting converted to stage 2 and further into stage 3? Are we still seeing a lot of challenging times for the borrowers? On matters like this, could you please provide some more color, and what could be the ideal provisioning levels that we should see on your stage 3 exposures?
Okay, Joyce, I will definitely let my colleague, the Chief Risk Officer, to chip in, but I think it's important to get the numbers right. We are very scientific in our approach to provisioning across all of these stages, stage 1, 2, and in particular stage 3. You may have seen that the stage 2, we maintain a much higher provision than the rest of the market, or the market average. And even in stage 2 is not 40%, like what you've just mentioned, is much higher than that. But I will let my colleague, the Chief Risk Officer, to shed some more lights on this.
Thank you, Ahmed. As you rightly mentioned, I think the numbers probably require some clarifications. Starting with the stage 3 level of provisioning that we have, it is certainly not 40% you mentioned. It is actually, as on June, well above 75%. And the reason why it is probably at that level at which it has been actually at for a while now is because the calculation is adjusted against all the collaterals that are held against all of these exposures. And these collaterals, also to provide some clarifications, are not taken at face value. There are very steep haircuts that are being applied against these collaterals progressively. So as and when the value is actually eroded, the delta is being supplemented by additional provisions in terms of cash. So what you are looking at here is actually a very decent level of provisioning. Not only on the overall portfolio, but at multiple levels of the portfolio, particularly stage 3 that I have clarified, and as well as stage 2. And when it comes at stage 2, I'm sorry, I don't remember the exact figures that you mentioned, but it is worth clarifying that there are multiple layers of provisions that we take against all of these accounts. And these are starting with the model-driven ones, and there will be management overlays on top of that. These management overlays are starting with the model itself. They are model-driven, where we apply a lot of stress on the macroeconomic indicators. And there are regulatory overlays that have been imposed by the central bank during the 3 years of COVID, which have been also kept. They have not been released, despite the fact that a lot of the aftermath of COVID is behind us, but some is certainly left, as mentioned by the CEO. And there are the judgmental ones that are basically based on management decision. And collectively, all of these overlays are now at a very significant level against all of these exposures. And as far as the stage 2, 1, and 3 are concerned, these are driven, the decisions around them are driven by the regulation and by the accounting standards. And if you look at where we stand versus where the market is today, we are just there with everyone else.
Just to support your comments there, Majid, I mean, this is public analysis. Our stage 3 provisions over NPLs at 72.2%. That's the second highest in the market. Our stage 2 provisions over stage 2 loans at 18.3%, which is far ahead of the market. And the combined stage 2 and 3 provisions over stage 2 and 3 loans is 30.6%, which is the highest in the market.
In addition to that, we also maintain very healthy management overlays. There are good amounts of management overlays that we have kept aside to support the overall coverage under each of these stages, 2 and 3. Okay, we'll move on. Next question.
Yes, but just to clarify, because I was looking at the numbers and the stage 3 number, the stage 3 exposure, if you can just share the numbers, and if I'm getting my numbers wrong, then it's an opportunity for me to correct it, because the stage 3 numbers, what I was seeing is 216 million, and the ECL provisions that you're holding against those amount is around 98 million riyals.
Okay.
Am I getting it correct? Or
please feel free to send me a note or give me a call, Joyce, after this meeting. I'm happy
Joyce,
to
you
clarify.
can reach out directly to Mr. Craig, our Chief Financial Officer, and we'll clarify for you.
Thank you.
The numbers.
Sure. Thank you, gentlemen.
Thank you.
Another question that I have is on that is, I've seen that your investment banking team has been doing a terrific work recently. They have doubled your AUM during the course of this year, as compared to last year, and it crossed 1 billion riyals. Big congratulations to you on this.
Thank you.
And if we look at the pre-merger levels also, you have tripled your AUM. So, post-merger, pre-merger, you have done a fantastic job on that by the investment banking team. One aspect that I wanted to check is that what could be the nature of these services that you provide for these AUMs? And what kind of income contribution are we seeing from these? The reason why I'm asking this is because despite this huge leap in AUM, I don't see a major movement in the wholesale banking income, but I'm seeing it declining by significant proportions over the last 3 quarters. If I'm to give you some numbers, the wholesale banking income in 4th quarter was 13 million riyals, and it fell to 8.5 million riyals in the 1st quarter of this year. And then we witnessed a further decline of 10% in the 2nd quarter. So, could you please provide some insights as to what kind of services are we providing there, and what are we seeing as the reasons for the decline in wholesale banking income?
Okay, Matthew, I will just briefly give you some key highlights, and then maybe my colleague Chief Financial Officer can chip in. First of all, on the investment banking, we have broadened our service offerings, and we have strengthened our capabilities and the skill sets that we had there before. That's why you see we're able to attract a lot more businesses, particularly in advisory and corporate finance and other stuff. So and custody services and all of that stuff. So we've been able to penetrate a lot more deeper and broader to different segments, and that's why we're able to do this. The second thing on the wholesale banking overall income, I don't know which numbers you're looking at. You may be looking at the net numbers. So there could be, but if you look at the operating profit, the engine has been performing well. But because of maybe provisioning, and when you net off, then you come that. Again, it goes back to the principle of prudence in our approach to maintaining a healthy book. But my colleague, the Chief Financial Officer, can shed some more lights if you, Craig.
Yeah, so once again, Joyce, if you wouldn't mind sending me some numbers that you're quoting, I can't see those. And I think this is the forum. So if you can give me some details of what exactly you're asking, what numbers you're quoting, we can respond appropriately.
Sure. I'll take this offline and we'll contact you for this.
Thank you, Matthew.
Another question that I have is, if I may take that question, if you can take that question.
Yes.
Yeah, this is on your capital adequacy levels. See, what you have one of the best core equity tier 1 capital adequacy ratio, but at the same time you have the lowest total capital adequacy ratio. And you have mentioned that you are looking at a high single-digit growth, but the room for further asset growth that I'm seeing is maybe around 15% with the current capital levels. So, what's your strategy for enhancing the capital levels? Will it be through equity or through additional debt, perpetual debts, or what's your strategy, and how soon are you planning to approach the market for this?
Thank you, Matthew, for the question. I very much expected this question to come, but I can assure you we will maintain sufficient capital to support our growth plan. And the capital structure that we are going to have will be optimal to ensure that you get better returns. And therefore, you don't have to worry about the number you are seeing today. We have a very robust plan, and we'll announce this to the market in the coming months or quarters. And be rest assured that we will maintain sufficient capital to support our growth. We have very strong shareholder structure and support. Over 70% government, with very strong support from all our shareholders. Plus, if we can complement that CET1 with some other capital instruments, such as perpetual at the right price, we will maintain sufficient capital to support our growth plan. So don't worry, be rest assured, that is very much in our plans.
Okay. Got it. Thank you very much.
Thank you.
Wish you good luck.
Thank you very much. Abbas, you want to ask again?
Yeah, just a couple of ones. I mean, one of the questions obviously was on capital adequacy, but Joyce already asked you that. So thank you for the clarification. Second one is, can you talk about what happened with the Bank-Nisba merger? I mean, why did it sort of fall through after a long discussion? Could you share some more details about it? What exactly was the thing that stopped the merger?
Whatever happened, we disclosed. And that's it.
Okay. No, I was trying to understand that. Was it valuation? Was it the fact that they wanted to be one standalone Islamic bank in the country, which would not be, a window? Was any of those reasons?
We disclosed Abbas. I think maybe we need to refresh our memories going back to the disclosure we made on this.
Okay, I'll go back and I'll go back and check it. Thank you.
Okay, any more questions? It seems there are no more questions. If no, please allow me to say thank you very much for your participation, your time, your questions, your insights, and have a great day, and we'll see you in our next session. Thank you very much.
Thank you.